According to recent statistics, life expectancy have increased, and you can expect to live to 80. With inflation hitting record high, retirement may seem scary for those who will retire soon, while those retiring years from now will not be affected as much. So, how to protect what you've saved from inflation and volatility, and how to access cash when you need. We're talking about the bucket investment strategy today on the Financial Advisor Show. The bucket investing strategy is an investment approach that segregates your sources of income into three buckets. Each of these buckets has a defined purpose based on the when the money is for. The immediate bucket, or the first bucket, this is where you'll place the money you need to access now to cover your expenses for about 2 years. Here you can invest in cash and short-term investments like money market funds and short-term bond funds, where you can access your money as and when you need it to cover living expenses. You're losing money to inflation, but you need that money for expenses. The intermediate bucket, or the second bucket, here you're looking a little further into the future to cover your expenses for years 2 through 7 of your retirement. However, you don't want to invest this money in something with a high risk of volatility. Instead, you want to keep it in a low to moderate risk category that offers a reasonable return on your money. Typically, you should invest in dividend stocks, long-term bond funds, and real estate investment trusts. The long-term bucket, or the third bucket, it is in this bucket you want to see as much growth as possible. The goal here is to beat inflation. Ideally, you will want to invest more aggressively in growth stocks, value stocks, and long-term investments because you're trying to make your nest egg outlast you. The idea is that you have to rebalance your portfolio every year and refill the first two buckets, especially when the market is up. This strategy appears to insulate a retiree from short-term market fluctuations. Even if stocks drop, the retiree is protected with 2 years of cash and another 5 to 7 years of relatively safe bonds. It also isolates risky investments like stocks into a bucket that won't be touched for many years. This strategy is not perfect and does not beat inflation, especially in early years, but will sail you safely through retirement. Thank you so much for watching, and feel free to join the Financial Advisors Show community by tapping that subscribe button and clicking the bell notification as well as following on other social media pages. It is totally free and you will never miss an episode.